Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at unusual machines.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis. Unusual Machines is a really fascinating small cap hardware company.
Yeah.
They're really in this sweet spot between commercial drones and, well, national security needs.
Yeah.
They make small drones, but more importantly, the guts inside them, the essential components.
And it's not a simple one-lane business model, which is what really caught my eyes.
No, not at all.
When you look under the hood, they have this interesting duality in their revenue stream.
That's the word for it, duality.
You've got the consumer side, which is all about FPV, first-person view hardware. That's built on some really smart recent acquisitions.
And then there's the other side.
The other side, this emerging B2B component business, which has this huge geopolitical and defense angle.
And that duality, I think, is the core of the whole thesis here. You could say this company has built two separate, really durable competitive advantages. Moats.
And they built them fast, mostly through moves they made back in early 2024.
Exactly.
Okay, so let's unpack that. The first moat, that's all about community, right? Brand loyalty.
Pure community. So back in February 2024, they made two huge acquisitions. One was Fat Shark.
A legendary name. If you're into FTV, you know Fat Shark goggles.
The historic leader, for sure. But the other one, arguably, was even more powerful. They bought Rotor Riot.
Which is more than just a store.
Oh, much more. Rotor Riot isn't just an e-commerce platform. It's like the epicenter of the whole FPV community.
And for anyone who doesn't know, FPV flying it's a super passionate niche. It's DIY, it's competitive.
Right.
These pilots are not just buying a gadget off the shelf. They are deep in the culture, the races, the mods. Rotor Riot is their hub.
Exactly. You're talking about a sticky, highly engaged customer base. And that community moat is showing real numbers.
Like
Rotor Riot has been showing, for several years now, better than 30% annual sales growth.
Wow, okay.
The kind of network effect, that's a stable base. It's incredibly difficult for a competitor to just, build that kind of loyalty from scratch.
So that's the community and growth engine. But the structural advantage, the one that really separates them from all the other component makers using overseas parts, that's the regulatory moat.
This is the crux of it. This is where the story gets really compelling.
Yeah.
Unusual Machines designs and makes components that are specifically NDAA compliant.
And the National Defense Authorization Act, that compliance is basically a stamp that says this wasn't sourced from China.
Precisely. Which caters directly to the U.S. government, defense contractors, critical infrastructure, anyone legally required to have a clean supply chain.
And it's not just a claim they're making. They've actually quantified this, right? How did they turn that into a real win?
Well, the win came in August 2024. The Defense Innovation Unit, the DIU.
They're the ones who basically vet technology for the Department of Defense.
Right. And they approved 3 of their components plus variants for their Blue Framework list.
And if you're not familiar with the Blue Framework, just think of it as the pre-approved, highly vetted shopping list for government drone parts.
It's the ultimate golden ticket. Getting on that list, and we're talking a flight controller, a motor controller, and a camera system. It just transforms the whole procurement process for their customers.
It goes from a months-long headache of due diligence to a simple, trusted purchase.
It makes them the path of least resistance in a world where supply chains are getting very polarized.
So you have this fantastic setup, organic 30% growth on one side, and this exclusive B2B pipeline opening up on the other. But growing a hardware company takes money. What's the strategy there?
It's very aggressive, and it's focused on scale. So you have the organic growth from the current businesses, but that's combined with highly strategic M&A.
And they're not just buying anything.
No, they're explicitly targeting cash flow positive acquisitions, maybe in SaaS or other B2B component areas that can immediately help their consolidated cash generation.
So they're not looking to burn cash on unproven tech. They want to use M&A to generate the money for the next phase. Something like an Aloft Technologies, maybe? Something with high margin, recurring revenue?
That's exactly the kind of profile they're looking for. They need to smooth out the lumpy nature of pure hardware sales.
Makes sense.
But their biggest spend right now isn't even M&A. It's a massive strategic shift in their physical supply chain.
You're talking about onshoring, bringing manufacturing back home.
Yep. That's the core execution story right now. Moving production of these NDAA-compliant parts domestically is critical.
To keep that blue framework advantage.
And to control quality and protect their IP. They hired a VP of manufacturing back in January 2025, and they have concrete plans.
Which are?
To start producing motors,
right.
high-volume motors, in a new facility they're building in Orlando. And they're targeting Q2 2025 for that to go live.
Building a domestic factory from scratch is, well, it's notoriously difficult, especially for something like precision motors.
It is.
So how does a company this small, we're talking a really lean operation manage, integrating two companies and building this complex factory at the same time?
That is the central challenge. And it's why investors need to see this as a multi-year build-out, not a quick flip.
So the goal is to lower costs on those high-volume parts and improve margins over time.
Right, improve gross margins. But in the near term, this huge commitment means massive capital expenditure.
I have to imagine that initial CapEx, plus the integration costs, plus the risks of a new factory, I mean, things like yield failures or finding staff, that has to put a ton of pressure on their operating margin right now.
Absolutely. They're a post-IPO company from 2024. They are fundamentally in heavy investment mode.
Yeah.
Every spare dollar is going into manufacturing, R&D, and future M&A.
So JAP profitability, near-term cash flow, that's not the priority.
Not at all. You have to accept that you're underwriting a growth story, a structural infrastructure play. The returns are deferred.
Okay, this is where it gets really interesting for me and maybe a bit counterintuitive. Despite all that, this capital-intensive pre-profitability phase, the market's reaction has been incredibly bullish.
It seems like a disconnect, doesn't it?
It does.
But it shows the market is looking past the next 2 quarters and seeing the long-term structural tailwinds.
Yeah.
I mean, look at the technicals. The relative strength rating just jumped from 88 to 94.
94. So over the last 12 months, the stock has outperformed 94% of the entire market.
It's astonishing for a small company in this kind of transition. That's textbook technical leadership.
So the market isn't just saying this is a good company. It's saying this is one of the absolute best performing stocks right now. What's the narrative driving that?
The narrative is explosive growth tied to national security. We saw a huge momentum burst. I think it was a 10.7% surge in a single day, right after a prominent analyst named it a 2026 top pick.
And the consensus is bullish across the board.
Overwhelmingly. The average price targets are way above where it's trading. We're talking around $18.67, with some targets hitting $20.
Those prices can't be based on current financials. They have to be completely based on future expectations.
They are. The entire bullish case is banking on what analysts are calling the unmanned supercycle, starting in 2026.
Meaning a massive, irreversible flood of demand for domestic NDAA-compliant parts.
And they see Unusual Machines as one of the main pre-vetted companies ready to catch that wave.
If everything is so great, there has to be a counterpoint. There has to be a reason for some skepticism.
There is, and it's a big one. Elevated short interest.
Okay.
This is the risk that balances that bullish technical story. Short interest has climbed to 16.42% of the float.
And for context,
The peer average for similar small-cap hardware companies is about 8.22%.
so they're being shorted at double the rate of their peers.
Exactly. That signals a big chunk of the market. The bears are deeply skeptical.
Okay.
They don't believe management can actually execute on these ambitious plans.
They think the factory won't ramp on time or the M&A won't integrate properly.
That's the bet they're making. The high short interest means the market is pricing in significant execution risk. However,
Go on.
when you get that high level of skepticism, but you combine it with improving technical strength, like that RS94 rating, you get a very explosive dynamic.
A potential short squeeze.
The perfect setup for one. If the positive news keeps coming, say, they announce the Orlando facility is opening on time, or they land a major B2B contract because of their blue framework status, that huge short position could be forced to cover.
And that short interest, instead of being a risk, becomes rocket fuel.
Exactly. It adds to the existing momentum.
So what are the immediate catalysts? What could kick that off? Management is pretty focused on getting their story out there.
They are refocused. They're actively getting in front of major investors. The big near-term event is coming up fast. CEO Alan Evans and COO Drew Camden are hosting a fireside chat and one-on-ones at the Needham Growth Conference. That's on January 14th.
And for a small company, what did you say, 16 employees?
Just 16.
Getting that kind of face time at a major conference provides huge visibility. It lets them tell that story, the dual moats, the blue framework, the onshoring, directly to the people with the capital.
It's a huge moment of accountability, but also opportunity. But like we've been saying, the whole thing hinges on one thing.
Execution.
Execution. And that brings us right back to the main risk.
Let's just break that down one more time, because it really is the gap between a $5 stock and that $20 price target.
It is. You have a company with an incredibly small team, 16 people, simultaneously running three, massively complex operations.
One, integrating the 2 acquisitions from 2024.
Which is never easy. 2, building that new domestic factory in Orlando from the ground up.
Navigating supply chains, specialized labor, all of it.
And 3, they are planning more aggressive, maybe even transformational M&A this year.
It sounds like they have the workload of a mid-cap company, but the staffing of a Series A startup.
That is the perfect way to put it. Failure on any one of those 3 fronts, the factory ramp, the integrations, the next M&A, any stumble could cause their growth to fall way short of what the market expects.
And those high price targets are already baked in.
Exactly. If they stumble, that bullish view could invert very, very quickly.
So if we zoom out and put the whole story together, the tailwinds, the moats, the bullish analysts, and this massive execution risk, what's the final thesis here?
The underlying thesis is that this company is a structurally favored beneficiary of powerful, secular geopolitical tailwinds. I mean, the market is literally bending in their direction because of national security mandates.
So the combination of the brand, that unique regulatory moat from the Blue Framework, and the M&A optionality, it positions them perfectly for the big shift away from Chinese drone supply chains.
It does, but it's an investment that requires absolute faith in the management team's ability to pull off an operational miracle over the next 2 years.
Riding that wave toward the 2026 supercycle?
That is the contract you sign with this stock. The geopolitical tailwinds and the regulatory moat, they provide an asymmetric opportunity. The potential upside is much larger than the downside if they succeed.
But you have to be willing to underwrite that massive execution risk.
You have to. This isn't for day traders. It's likely a 12 to 36-month multi-year hold, targeting that unmanned supercycle everyone is anticipating.
A fascinating analysis. It draws a really clear line between the huge potential and the massive operational hurdle they've got to clear.
It really does.
The future price of this stock seems like it's going to be a direct referendum on the leadership of that small team over the next couple of quarters.
Indeed. It's a high-stakes infrastructure build disguised as a small-cap hardware stock.
A great breakdown. For our listeners, if you are finding this kind of detailed analysis helpful for your own research, please consider subscribing to the podcast. Your support helps us continue to analyze these complex market opportunities.